Hey, everybody. Mike here, Practical Income Investing. Well, Google just reported one of its biggest quarters in history, and Wall Street turned around and knocked 7% off of uh, off of the stock. So now, if you're scratching your head and wondering what the heck happened with this company, how can you can absolutely crush earnings and then still get sold off? You're not alone. Honestly, I was that was my first reaction too, you know. But once I dug into the numbers and I started to see what was going on, it made a heck of a lot more sense, to be honest with you. So today I'm going to do something a little different. I'm not going to just tell you what happened. I want to show you why it happened. I want to show you why Wall Street is a bit scared and why I think they might have it a little bit wrong. I think they're overlooking some things. And I'm not going to just show you uh, how it and why it happened. I'm going to show you what I'm going to do. I'm going to show you how I'm playing this reaction with my own money, and because that's what this channel is all about. So, hey, let's just jump right in. Thanks for watching. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. All right, let's get everybody on the same page really quick here. Google didn't just have a good quarter. This sucker had an outstanding quarter. So, I mean, revenue came in $121 billion. Earnings per shares jumped to $9.11. The Google Cloud delivered another excellent quarter and continues to grow. And it's growing faster than a lot of people expected too. So the search is generating an incredible amount of cash. Gemini continues to become bigger and bigger, and is a bigger part of Google's AI strategy too. Honestly, if you looked at those headline numbers, you'd probably expect Google stock to, like, be way up today, not down almost 7%, right? Uh, But Wall Street wasn't focused on what Google's earnings was this quarter, right? I mean, they were focused on what Google's going to plan on spending over the next several years. And that's really where this entire story begins. Let's let's start with one of the biggest reasons I'm still optimistic about Google company, right? As a company, it's the Google Cloud. Now, here's the part that really caught my attention. So, Google Cloud absolutely crushed this quarter. Revenue was up more than 30% over year. And that's not just good, that's exceptional, especially for a business this size. If you think about it, what's driving that growth? Companies all over the world are racing to build these AI applications. They need that computer power, they need the storage and infrastructure, and Google Cloud is one of those places they're turning to, right? So now, is Google the biggest cloud company? No, it's not. Amazon's still number one. Microsoft is incredibly strong. But I'll tell you, Google, they're not trying to win every customer overnight. They're just like kind of proving they belong in the conversation. And when a business this large starts growing one of its biggest divisions at this kind of pace, I'm paying attention, because this isn't just about a good quarter. This is about where Google could be in 3, 5, even 10 years from now. Now, here's something else that really made me think. So, a couple of years ago, somebody came along uh, and tells us Google search is dead. And honestly, I kind of smile every time I hear that, because it's almost like somebody's telling me that pizza is going out of style. Could search change? Sure, absolutely. In fact, it's already changing. AI is changing the way people search. But you know, there's a question here that I keep asking myself: is Google losing people? Because those are two completely different things. Google's integrating AI directly into the search, right? So Google or Gemini is becoming part of that experience. people are still asking questions. They're just asking them in a different way. So as long as Google keeps finding ways to answer these questions, I don't think search is going to disappear. It might evolve, but that's a very different investment thesis altogether. All right, now here's where it starts to get really interesting. Google isn't spending all this money just because they like building expensive computers. You know, they're spending it because they believe AI is going to change almost every product they own. And honestly, when you really stop and think about it, Google has a pretty incredible ecosystem already. They've got search, Gmail, YouTube, Android, Google Cloud, Workspace, Maps. I mean, billions of people are already using these Google products every single day. And I'm one of them. I'm one of those locked in, So here's a question I ask myself. If Gemini gets built into all of those products, how valuable could that become in 5 years from now? I don't know the answer. Nobody does. But I do know this: Google's not making small bets on it. They're making one of the biggest AI bets on the planet. And whether that turns into something incredible or if it's a very expensive mistake is exactly what Wall Street is trying to figure out right now. Okay, so here's the catch. This is where Wall Street kind of said, hold on a second. Google didn't announce that they were going to spend a little bit more money. So they basically said, we're going all in on AI. And holy cow, we're talking about close to $200 billion in capital spending. So I get it. This isn't pocket change here. This is a serious commitment. Now, here's where I think a lot of investors get tripped up, though. They hear a number like $200 billion, and the first thing they think of is, man, that's expensive. And you know what? They're not wrong. I mean, it is expensive, but here's the question I keep asking myself: what if Google does not make this investment? What if they don't? What happens then? AI isn't slowing down. Microsoft spending, Amazon spending, Meta spending. If Google sat on the sidelines trying to save money, I'd actually be worried more. Sometimes not spending is the bigger of the risks that they can have. Okay, now here's where the light bulb kind of went out for me, because I'll be honest, the first thing I'm sitting here thinking, what the heck are they selling this thing for? Then it clicked. Wall Street wasn't looking at Google's earnings. They're looking at a checkbook. Think about it. Like, if you're writing checks for close to $200 billion, that money has to come from somewhere. So even though Google made a ton of money, free cash flow took a hit because they're pouring so much back into AI. Now, does that make Wall Street wrong? No. But they're looking at the next couple of quarters. I'm looking at a little bit further down the road. And I think, honestly, that's the difference. I think that one of the biggest lessons I've learned in investing, sometimes everybody's looking at the same company, they're just looking through a completely different time horizon. All right, now let's talk about this $9.11 per earnings per share. So, because on the surface, look, this number looks absolutely fantastic, and it was fantastic for the quarter. But here's where as investors, we got to say, hold on a second now, exactly what am I looking at here? Earnings per share is important. I'm not trying to tell you it isn't, but a one big EPS number doesn't automatically mean every part of the business is suddenly, become more profitable. Sometimes earnings get a lift from other things, that might not repeat every quarter. So, like investment gains, accounting items, tax effects, share count changes, all of this stuff can move the final number around. And this is where people can get themselves in trouble. They see $9.11. They get excited, man. Holy cow. 260% increase or whatever it was, And I assume Google's core earnings power just exploded overnight. Well, hold on, slow your roll a little bit here, right? Uh, the numbers matter, but listen, you still have to separate the repeatable business performance from the stuff that might have been juice for that quarter. Here's the simplest way to explain it. So EPS tells you where or what landed on the scorecard, right? Cash flow tells you what happened in the game. And when you put, if I can put this in my own money to work, okay, and I want to understand both, because one shiny number can look pretty damn good, but I'm investing in the business that's underneath it. All right, let's put this all together, because there's a lot going on here. Google didn't just beat expectations; it beat them in a pretty convincing way, right? Search is still incredibly strong. The cloud continues to gain momentum. Gemini is getting built into every single product, one after another. The business itself looks healthy. So why did the stock fall? Because Wall Street basically said, "We like everything you're doing, but holy smokes, man, you're spending way too much money while you're doing it." And honestly, I kind of get both sides actually. If you're a trader looking at the next quarter or two, that spending probably makes you look nervous. But if you're a long-term investor, you might look at this in a way that you might say, okay, this is exactly what I want to see a company doing. I mean, same earnings report, completely different conclusion. And that's what makes a market. All right. Now, if you watch this channel for a while, you already know that I look at both sides. So let's do exactly that. All right. So here's a bull case. Google has one of the best businesses on the planet. There's no question about that. Search is still a cash machine. Cloud is growing like crazy. Gemini is getting better every single quarter. They generate an unbelievable amount of cash, and they're investing heavily in what could be the biggest technology shift that we've ever seen. So that's a pretty strong bull case in my opinion. But I'd I'd be lying if I said there wasn't risks. Spending close to 200 billion dollars is a heck of a commitment. If AI doesn't generate the returns Google is expecting, that's a problem. Competition isn't slowing down either. Microsoft's coming, Amazon, um, Meta is spending like crazy. It isn't a game where Google gets to play by themselves, right? So yeah, there are risks here, but here's how I look at it. I'm not trying to figure out who's going to win every quarter. I'm trying to figure out who's going to be standing after 10 years from now. That's a completely different question. All right, so here's what I'm doing, okay? Not what you should do, just it just makes sense for me, okay? So I actually added exposure after this pullback. I bought some leaps because I like the long-term outlook of Google, it being one of the AI companies, the biggest AI companies in the world, right? So now I'm backing it up the truck a little bit. I'm am I betting the farm? Heck no. uh, it's not how I invest. I build positions over time. I dollar cost average in. So if we were to get another pullback, I would just simply look to get into another leap or whatever. So um, I look at red days as opportunities, especially on companies that are monster companies, big earnings, uh, that fit my 7 fundamental principles. So I'm already in the game, right? So I'm also looking to defend some risk premium strategies here. I like some credit spreads, put credit spreads to be specific, because I like generating income while my capital is working efficiently. That's how I get it to work efficiently. So that's how I think about investing. I don't feel like I have to hit a home run every time I swing. If I can consistently put good businesses in my portfolio, collect premium along the way, and let time do the heavy lifting, I'm perfectly happy doing that. Now I could be wrong, of course. I mean, no one's perfect, but at least I have a plan. And in my experience, Having a plan beats chasing headlines every single time. So now, before I wrap this up, I want to leave you guys with one thing I think is a lot more valuable than just seeing today's earnings report. Whenever I'm looking at a company, I try to step back and ask myself a few questions. Is the business growing? Is it making money? The management, are they investing in the future, or are they just trying to make the next quarter look good? Does the company have a real competitive advantage, or is it just riding the latest trend? That's why I like looking at a snapshot like this. It forces me to stop reacting to headlines and start looking really at the actual business, my 7 fundamental principles, because at the end of the day, I'm not buying a ticker symbol. I'm buying a part of a company, and when I can remind myself of that, and it usually helps me make better investing decisions. Well, I hope this made a little bit more sense for you with what happened with Google. This is really what practical income investing is all about. I'm not here just to tell you what happened. I'm here to show you how I think through these investments, why I make the decisions I make, and yes, sometimes why I change my mind. So every Tuesday, I'll bring you a new case study where we'll break down companies' earnings and opportunities just like this one. And then every Friday, we'll check back with that investment we've talked about here in the channel. I'll show you what's changed, what I'm thinking, what I did, and just as important, what I decided not to do. So if I add a position, I'll tell you. If I trim, I'll tell you. And if I completely change my mind, I'll tell you that too. Because investing isn't about being right all the time. It's literally it's about having a process, learning from it, and getting a little bit better every week. So if that sounds like the kind of investing journey you'd like to be part of, I'd love to have you along. Um, Thanks so much for watching. Take care, everybody, and we'll see you on the next case study.